Welcome to Markets Now. I'm Michelle Rook with Ted Seifried, Zaner Ag Hedge, and we saw a higher day with the exception of soybeans, which were just slightly lower. And Ted, let's talk about the wheat market. New highs for the move, all three exchanges up from 11 to 21 cents. So it looked like we were putting war and weather premium in. How much do we need to have in this market?
Yeah, I mean, that's a great question, Michelle. And certainly when you have uncertainty over weather and struggles happening in some major producers across the globe, and when you have global conflict happening with major wheat producers, again, that causes a whole bunch of uncertainty. And uncertainty usually means higher prices, especially when you had managed money that had been short the wheat market. They're not as aggressively short as they had been, but they still were short. So continuing risk off, and in the case of wheat, and really actually the rest of the grains, risk off means short covering. So that gave us some higher prices. Now, how high does it have to go? That's a great question. I think the funds are getting pretty close to being done with covering their short positions. In a risk off scenario, to me, that would suggest that they're not looking to get long on wheat or really any of these other markets, because the point is that they want to have less risk in markets that they consider risky. So I don't see them going long. If anything, I could see them going short again at some point.
So corn has been benefiting from the rally in the wheat market, but here too, funds have been covering shorts. Are they about done covering? Is that rally almost over too?
The strength in wheat today definitely spilled over to corn. But if you look at it, corn cleared its 100-day moving average, closed above it, just barely above it on Tuesday. And then Wednesday, we did extend beyond it, but it wasn't a statement day. I didn't feel like. I feel like corn could have done better with the amount of strength that we saw in wheat, and for the breaching a key technical resistance area. You really wondered if it could be an acceleration day for corn, and it wasn't. So I was a little bit disappointed with that. To your point, the funds had been short about 124,000 contracts as of last Tuesday. With the amount of strength that we've seen since then, you would figure that they are probably pretty close to 60,000 or maybe even 40,000 left on their short position. So there's not a whole lot of fund buying power, I think, left in the market. And again, just like we talked about in wheat, a lot of this is based on risk off. It's not necessarily based on individual market fundamentals. It's based on just not wanting to have risk. I do think the bulk of the harvest pressure is still yet to come. And if that changes the look of this chart, well, then funds might actually start to want to get back in on the short side. So I'm a little worried that we have what I'm going to call a false bottom in there with that late August low. I think a really big deal for corn is going to be, what that October 11th report says. I think there's been a lot of speculation over the past month that the hot and dry finish to August and September has really, cut bushels off that corn yield. But then, just in the past week or two, we're kind of hearing from producers and, private surveys and things like that, that maybe that hasn't really been the case. And if the USDA doesn't lower their corn yield fairly dramatically, that could be a rather disappointing report on the 11th.
Soybeans also awaiting the report on the 11th, but we've been kind of moving sideways the last couple of days here. Is that market kind of putting in a top? Have we run into chart resistance enough times, or is the market just in a holding pattern as well till we see if we get these Brazil rains?
Yeah, so, a lot of things we just talked about in corn and wheat in regards to funds covering shorts, it holds true for soybeans as well. Risk off in soybeans means funds are buying because they want to get out of their risky short positions. And again, that wasn't necessarily triggered by soybean fundamentals by themselves, although the dryness in Brazil has been a reason for that. The warm and dry finish to our growing season has been a reason for that. But I think more than anything else, it's that global uncertainty, that global risk, right? So now where do we go, right? And yeah, we're getting closer to those forecasted rains in Brazil. They've really kind of stayed in there, so the confidence is building. Longer term forecasts, especially when we're coming out of an exceptionally dry period, we kind of need to wait and see if those rains do happen before we're convinced about that. But if those rains do happen, and then also, again, that October 11th report where the USDA is going to update their yield estimate, if they don't dramatically lower that yield, I think we're looking at a situation in soybeans that is a lot less bullish than what the board is reflecting right now. I also think that the stimulus package that the massive stimulus package that China is going to go forward with, it seems. While that could be more buying for soybeans in the near term, for the long term, that's actually really concerning for me.
And new highs for the move in both live and feeder cattle futures here today. Are the funds going to keep buying and pushing this market, and how high could we go? And how much of it's dependent on higher cash?
Yeah, an extremely impressive week for the cattle complex. Big day Wednesday. And we've cleared some very major technical resistance levels, which is a catalyst for fund buying. But we just talked about risk off in grains markets. They do seemingly want to take on risk in livestock markets, which is interesting, and it makes you wonder why, right? Because at this point, we've really erased the entire break that we had, through August and September, and you think about the time frame in between. There's been a lot of concern about the overall stock market. Yet, the Fed did cut basis points by half a point. So there is a renewed optimism in the economy, which means renewed optimism in beef demand. But I think with this port strike, we're going back to how we remembered, COVID and the logistical issues that we had at ports all across the country and all across the world. And you had this massive cultural movement to go and stock up on things and fill the freezer. And I think that speculators are kind of feeling like that same thing could be happening again with this port strike, or that could be the trigger for the masses to go out and do that sort of same thing. And while I don't really think that it's going to be a problem for our supply chain for beef, it might end up being a real big problem for our exports for pork. So I think it's great to see the strength that we've got going on across the board in livestock, and clearing some of these massive resistance levels. But I also think it's a really good time for producers to be looking at hedging the downside. I do worry about the economy. I worry about what our domestic demand is going to be as we get into the fall and winter months. I do think that we really need to see box beef prices start adding again really fairly quickly in order to suggest that this stockpiling is happening.
I'm sorry, it runs counterintuitive to me when you have a port strike and you have at least a third or at least 30% of your hog supplies that go out the export channels. Seems to me like that should be negative for hogs, but yet we took out the September highs today. Go figure.
Yeah, go figure indeed. I really don't get the feeling that the market has fully embraced the impact of what a ongoing port strike could be for markets that have exports as a big part of their balance sheet. So that would be pork, but also looking at the grains, in particular corn and soybeans. You haven't really seen any negative impact on the corn, soybean, or pork market, or hogs market, based on the port strike. And I think the general idea or the concept, or I think the market just feels like this is something that could get resolved very quickly. I'm not sure that it will. If it doesn't, then you feel like I think the market thinks the ABCs of the world, the major exporters, will find people to work the ports and still find ways to get this done. But I think what we're not considering is that the ship traffic and ships that are just lined up at port, waiting to get offload or unload or really get any sort of movement at all, is going to create just sort of mass chaos. And whether they can get the workers or not, whether they can get the barges down the river or not, which is that's gotten a little bit better, but it looks like it's going to get worse again. I think that it's just a very bad time of year to have logistical issues for the grains, but also for pork. And ultimately, we could be talking about the same thing a week from now, looking at it in a much different light. I'm worried it could be a very, very negative thing for the markets.
All right. Thanks for joining us, Ted Seifried with Zaner Ag Hedge. That is Markets Now.